So unemployment is rising, and sadly, it is going to get worse. Where the heck have all the jobs gone? And have housing prices hit bottom? I'm going to let you know. And the phrase, you'll own nothing and be happy, we're all familiar with it. Is that just another conspiracy theory that's actually unfolding here in Canada? We're going to find out. And what do investors really need to know in this market? Let's rein it in. I'm covering a lot of ground, but I'd love to hear from you. Put it in the comments. What do you think about these particular topics? What's your insights into what's happening? Are we really living through a conspiracy theory of you'll own nothing and be happy? So welcome to episode 70. My good friend and co-host JG Francoeur is on vacation. Good for him. But let's dig into some of the data. So I want to kick it off with what's going on in Canada when it comes to its economic growth. As we've talked about many times, more times than I can count actually, GDP, gross domestic product, speaks to the productivity of a country, a province, a city. And we need positive GDP. But the reality of it is, for the past 10 years, as this data is showing, Canada is just not being productive. We've said many times, Carolyn Rogers actually, in case of emergency, break glass. This is an emergency and all, she said that probably at least 4 years ago now, and nothing has changed. If anything, it's gotten worse. And as this chart shows, Canada is in the top 10 of the worst economic conditions, and it continues to actually spiral down. So when we look at this particular chart, we look at economic growth, our GDP per capita is just bad, and it has been because we've been always basing our economy so much on real estate and, of course, the immigration that's been coming into the country, particularly the past 5 years. Now we've cut off that immigration or slowed it down dramatically, and that's going to have an impact on the consumerism that was actually driving part of our economy. So it doesn't matter how we look at what's happening, Canada is in a slowdown. We can certainly quantify and qualify that in Ontario and British Columbia, particularly in the housing market. But Ontario is definitely being affected as well by the tariffs. And when it comes to manufacturing, and all of the uncertainty is just stopping companies from doing one fundamental thing, and that is creating jobs. So when we look at what's happening on the job vacancies, they're using the word collapsing given, and this is by BMO, by the way. So it's diverging significantly from what the U.S. is happening, although as of this recording, the U.S. has got to the reality that their numbers are not that accurate. Trump is doing what he's doing and firing everybody. But the point is this: Canada, regardless of what's happening in the U.S., the businesses in Canada are bumping up against the reality of the cost of living that people are experiencing. So they're slowing down. Consumerism is slowing down. Interest rates continue to rise. And always kind of keep one thing in mind is that a lot of people were borrowing money to pull the future into the present. So they were buying things because interest rates were so low. Now, that was often by use of a HELOC, and they were, whatever they were buying. They were buying boats, they were doing renovation, they were doing consumerism type things. Well, now what's happening is they've quit doing that because interest rates are high. Many have those HELOCs that they ramped up when interest rates are low. Now their payments are significantly higher. And by the way, some of those are going south. So when we look at the mess of the economy, given interest rates going up, given that it appears that interest rates aren't coming down anytime soon, perhaps by the end of this year, I'm going to just touch on that as we go forward. The point is this: businesses are not doing new business. They're not hiring. So the job vacancies, the availability of jobs is at almost record lows again. So people are out of work. Unemployment is going up. It will continue to rise. We don't know when that's going to change. And the Bank of Canada, like all central banks and like the Bank of Canada has kind of been guilty of in the past, they don't do enough, or they react too slow on either side. They either don't lower rates fast enough and then it's a catch-up game, or they do too much too soon, which is arguably what they've done when they hit the brakes and started ramping up rates so high. It really did slow down the whole economy overall. The point of it is that I guess we'll call it the job issues are going to continue to rise. We're going to see unemployment, job vacancies aren't there. Businesses are not borrowing more money. They're not growing their businesses because things have slowed down a lot. The consumers are not only don't have a lot of confidence, the businesses don't have a lot of confidence. And that is really, we're paying a price for that, and it's going to continue to pay. Now, some of that unemployment is certainly being driven, and it's going to continue to escalate. Like, there's no good news in what's happening in Canada. Let's face it. There's not a lot of things happening, especially in the real estate world. And you have to consider how many jobs are in fact, or were in fact, supporting the real estate market. Those jobs are now going away. Sales are down dramatically. Listings are up dramatically, but deals aren't getting done. So the unemployment, for example, in Ontario and BC continues to grow because those developers are not hiring. So when we look at what's happening in Canada, the slowdown, GDP growth being so thin, and arguably we're in recession in some provinces for sure. When you look at Ontario and even parts of BC, one could argue that it's recessionary. Now, without getting into the weeds there, we have to consider that our economy has been driven so much by real estate, and that slowdown has been quite dramatic right across the country. But the one thing that has happened is, we were listening to our government tell us that we are going to build 500,000 units. That was their goal. And it was based around some version of affordability, but they wanted to get housing starts. Well, the reality of it is that CMHC forecasted that by 2027, starts will only reach 200,000, which is 50,000 fewer than they even forecast for 2021. So despite the commitment, they're not building. We knew that would be what would happen, because that's just how government seems to roll these days. The point of it is this, is that when I talk about unemployment getting worse and job vacancy rates going lower, we just have to deal with the fact that our economy is not expanding right now beyond what it was with housing. So housing is slowing down. We connect the dots and we start to realize that all of those jobs aren't being picked up by another industry, by some other initiative that's being out there. The federal government is making promises about certain things, but nothing is gaining traction. So here's the point of it. When we look at annual housing starts, they're not coming online and they're not there. So we start to understand that industry is going to continue to be quite soft. So then we get and look at the housing starts, and what is happening is that when we look at this chat, we know that condos are just a non-thing anymore. I mean, the condo market in Toronto has totally collapsed. Vancouver arguably has collapsed in terms of new builds and pre-construction. They're finishing the projects that they're finishing to the degree that they can, but those jobs will in fact start to go away. Where they're picking up some of the slack, and it doesn't drive a lot of jobs, to be honest with you, is in the rental market. Purpose-built rentals. What isn't being built is, in fact, homeowner style of homes, those detached or semi-detached. Not a lot of construction going on there because buyers aren't stepping up, and as well because the math doesn't work for developers. What we start to realize is that even when we look at CMHC, this is a pretty dramatic chart in terms of what CMHC is providing, and guess where it's all going? Homeowners aren't buying. They're not using CMHC to buy, but rentals are up. So in other words, developers are borrowing a lot of money. And when we start to see where it's all going, it is going into the multifamily, into the purpose-built rental market primarily, and then the condo market is coming totally off the rails. Now that chart shows a pretty dramatic kind of divergence between the rental market and the condo market, but if you really want to see something, take a look at this chart in terms of development, what they call development surge. So apartment construction and mortgage loan insurance on the MLI Select program going to developers. So in other words, this is something that is already causing some issues, because CMHC has tightened up their lending. They've got a lot of capital at risk. They've got a lot of developers who are at risk of not paying. Some of them are, in fact, going out of business. And so when we look at CMHC, what does it mean for us and for those who are looking to get CMHC financing for their projects? Well, CMHC is tightening up. It's not so easy to get financing. If you thought it was hard leading up to now, just wait. It's going to get far worse. So when we look at that whole market, we see that jobs are going to continue to weaken just because of how much we depended on real estate for our employment, how much we depended on immigration for employment because it drove consumerism. These are all challenges that we're going to face. We've got a lot of purpose-built rentals coming online. So there are certainly going to be areas where it gets very soft. Look at Toronto, for example. Is the rental market, a lot of condos who are going to maybe be sold are now just going to go on the rental market. So you got thousands of condos coming online. You've got purpose-built rentals coming online. You don't have as much immigration. Oh man, it's getting messy in Toronto, and it's going to continue to be that. But we're starting to see that roll out in other regions as well. So now let's talk about property prices. This is an interesting slide because when we look at this particular slide, it was actually posted and somebody was going, oh, prices are down 23% since 2022. Well, I get where that, an all-time high, you're comparing it and they're saying it's going to go way lower. I don't think it's going to go lower. Let's go back to 1976, 1984. So if you look at 76 to 84, so about 8 years, 22%, then it took off. 9 years, 1989 to 1998, dropped 21% over those 10 years, and then it started to lift off. 2008 to 2009, a glitchy year, pulled back, coming off, and then it took off again. Now, 2022 dropped 23.5%. So if we look at the trend, it's still up. Is it dramatic? What is causing a lot of the drama is the fact that people bought at all-time high in 2022. They're trying to time the market. They didn't have any intention of actually taking possession of that unit. A lot of what is being driven here is the condo market. That's not to say that some single family detached isn't come down in price. But if you bought in 2022 and your intention was to sell, 3 years later? I don't know. This is where it gets a little bit, I don't know. We have to think this one through. But my point is this, is there's a good chance that we've hit the bottom of the market if we look at this trend line. Is it technical analysis? Not really. And do we have maybe a 10-year window of where prices are going to either go sideways or only go up very slowly? If we look at historically, that seems to be the trend. Again, it's hard to do technical analysis on housing given how long it takes for things to unfold. But I'm going to be looking at this really closely. I think that in many regions, we have, in fact, hit the bottom of the market. Now, can it come down a little bit more? I think so. But we're already starting to hear a little bit of within the realtor world saying, hey, it seems to be a little bit more active. So certainly nothing to get excited about. But the point is that we may, in fact, have hit the bottom of the market. And over the next 8 to 10 years, if we look at historical data, maybe that's where it's going. Something to consider as we move forward. Now, as we look at all of this data, there's one underlying, and we see it in the headlines. It's talked about. It's a constant conversation. And the reality is that so many people are hoping and wishing that housing affordability would improve and that house prices drop. I'm going to talk about comments shortly, but some of the comments we receive, some guys are waiting for an 80% drop. So here's the fundamental. It's important to be careful about what we wish for. As I kind of unpack this, I'm looking at the headlines and everybody's complaining, young people can't buy a house. And I get it. And I think that it should be a right for Canadians to be able to afford a home. It's just not the reality of what's happening. But as much as we wish and we hope for prices to come down, there are unintended consequences that we have to think through. So when I kind of looked at this, I said, well, it's easy to look and say prices need to come down, but what's the downside of all of that? Now, as investors, we're going, no, we don't want prices to come down. Got that. And this is more about just people in general, that we have to understand that this wish for prices to come down to be more affordable, there's some consequences that are going to come down. So I'm going to state some obvious ones, and that many of you will already get, but there's some here that I think you're going to say, oh, that's an interesting thought process. So first, number one, I think, and this isn't in any particular order, but we know that house prices drive our municipal revenue, and we are at the risk of a municipal revenue crisis, if you will, because property taxes are based on assessed values. So if we see a sharp drop in values, it means that municipalities are collecting less tax. So they'd be forced to either cut services, for sure, they'd be forced to cut staff, they're going to have to raise tax rates, or take on more debt within the city to maintain operations. And when you look at across the country, cities are already looking for provincial support and or more federal support because property taxes have gone up. There's still not enough to deliver on what they say they're going to deliver on as a municipality. So that's number one. Number two is we have to look at, we're already being aware of, and I shared that with CMHC, there is going to be banking system instability. There already is. If prices come down, let's take $1 million home that the bank lent $800,000 on. So somebody said, okay, I'm going to buy this $1 million home. Here's my $200,000 deposit. And boom, the next thing you know, that house is only worth $775,000. So the loan to value ratios are going to get out of skew. And so mortgages would then become underwater. In other words, owing more than the home is worth. This increases default risk. It actually forces loss provisions. OSFI drives that bus a lot, and then it weakens the bank balance sheet. So it could, in fact, trigger a credit crunch, tighter lending. Well, could it? It already is. Anybody looking for a mortgage, whether you're an investor or even buying a home, the credit crunch is definitely starting to ramp up. Banks are getting far more, difficult to deal with. You're jumping through a lot more hoops. Okay, third, consumer confidence. This is one that I talk about ad nauseum because it's so important. Consumer confidence is it's not at all-time lows, but it's low. And when we start to see the consumer confidence, we start to see a collapse in what we'd call the wealth effect. Is that people don't have confidence, they stop spending less, they're losing equity in their home. Well, the other side of that coin is they already have HELOCs that are lent against that property value. So people tighten up, which means reduce spending, which means an economic slowdown because consumerism isn't happening. And we're already in a low productivity environment in Canada in general. And so the psychological impact is of fear of further price drops, which means they're delaying purchases, which means that businesses are touching the brake in terms of hiring. This goes back to what I said earlier. It becomes this downward spiral. And then homeowners, when they feel poorer, they spend less. And of course, they're used up their HELOCs and they're stretched. And if prices come down even further, that only increases all of that. Number four, negative wealth effect. I just mentioned it, but home equity is the largest asset of most Canadians. As a matter of fact, when you look at the boomers, the number of boomers, many boomers are counting on that equity, that home ownership equity, to be part of their retirement plan. So you got less equity, you got less borrowing, you got less business investment, you got boomers that are upset because now they can't, in fact, retire the way they thought they might. And this, of course, leads to a lot of political pushback. This is what they are going to be, it's what boomers voted for. Let's face it, elbows up. They thought that our current federal government was going to actually manage that aspect of what they're doing. So my point is this, I'll go away from the politics, but when you are a boomer, as an example, who is depending on their equity in their home for their future retirement and prices drop, that's not good. That will create number five, which is the political fallout. So if those same boomers make up a large voting bloc. So when you see significant price drops, you're going to have public outrage no matter what. You got a bunch of boomers walking down the street with knee braces and canes, shaking it at the politicians, going, "This isn't fair." So you're going to have them protesting in the streets, and then the next thing you know, you got policy reversals because it's always politics over policy, and they're going to go with whatever the populist is talking about. So that's definitely something that has to be considered. Number 6 is construction and trades. We've talked about that a lot. That slowdown continues, and lower prices just equal fewer new builds. We're already experiencing that. So this isn't really a new thing. It's not an unintended consequence. Well, it is an unintended consequence, but we're in it. So losses in constructions, trades, suppliers, the whole real estate sector slows down, and our housing industry is a major GDP, had been a major GDP contributor, and of course that has gone to the wayside. Number 7, this has in fact been happening, and that is CMHC and government exposure. When you look at what's happening with prices coming down, that loan to value ratio goes out of whack. It puts banks at risk. So we're really starting to see the impact of that even in the Toronto condo meltdown. And we're starting to see that builders aren't building as much. And so this goes back to number 8, which is in fact prices are coming down. Fewer things are being built. That is going to lead to perhaps a shortage, but the shortage is going to be very specific property type, and it's not going to happen for years to come. How do you anticipate that? So when we look at the unintended consequences, housing affordability is nice to talk about. We would love everybody to own a home, but crashing home prices are going to hurt renters. It's going to hurt homeowners, governments. It's going to hurt banks. So there's a part of it where I think very likely you're not going to see prices. It's another argument for why I don't think prices are going to drop dramatically. I think the bank will in fact step in. It'll be too late. I think we'll see interest rates probably come down closer to the end of the year because we're going to see the economy get much softer. We're already seeing that. I think Macklem is going to have no choice. Our Bank of Canada Governor, Tiff Macklem, is going to have no choice but to bring those rates down. And then it's going to take another 18 months for the impact of those rates to have the consequence of getting the economy back up and running again. So the unintended consequences are, of home prices coming down is the municipal revenue collapse, property taxes, lower prices overall. We have to really consider that aspect of it. So as you're looking at what's going on, just keep in mind, lower housing prices at the top line seem like a good idea, but there are unintended consequences that we have to be aware of, so we're not buying into the emotion of it. So we always appreciate your comments, your likes, your subscribes, but your comments are always great. I want to respond to a couple of your comments, not the least of which there was one that was talking about the sky is falling. Real estate is doing what real estate is doing. It's done what it's always done, and it's still not affordable. Well, great comment, great observation, understood. But this goes back to what we often talk about and why buyers are sitting on the sidelines. It could be because it's unaffordable. Yes, they can't afford it. I agree that in some areas it's right off the charts. Here's the thing about it is that it isn't going to change. And this goes back to what I said before. We want prices to come down, but there's consequences for that happening. So all to say is that if you're sitting on the fence waiting for prices to come down, you may be waiting a long time. Probably a better strategy, better thought process. I'm going to wait for interest rates to come down, and keep in mind they're only going to come down probably a quarter, maybe a 0.5%. I don't see them coming off any more than that. They're certainly not going back to those all-time lows. So yeah, it's still unaffordable. This goes back to one of the things I'll insert here is the comment of you will own nothing and be happy. Now that statement came out of the World Economic Forum a long time ago, like 5 years ago, but it's been on their agenda for many years. So the whole concept of you'll own nothing and be happy is that the oligarchy, if you will, the BlackRocks of the world, the corporations of the world will own everything. you'll own nothing. You will rent everything. You will walk places. You will use public transit. That's all part of what this you'll own nothing and be happy is. Now, there's probably a strong argument in some people's minds for that, but it's not a choice. It's like you have no choice. You have to go that way. So that's the concept of the 15-minute city, which speaks kind of to our other comment, which is a fourplex. He's seeing Edmonton. I'm curious to see how renters in a new unit in a fourplex infill property with limited parking versus a recently renovated property with plenty of parking. Well, here's the thing. We're knowing and seeing the data supports it. There are lots of young people that are not interested in owning a car. Edmonton specifically is building a 15-minute city protocol, which means they already have 14 districts. The intention of each district is that they want you to not go outside of that district. And if you do, it's not a case that they don't want you to. They don't want you to drive outside that district. So they want you to walk, take a bike, take public transit. The whole point is minimizing or limiting your carbon footprint. So in some cases, yeah, the fourplex that you build with parking is going to attract people with cars, and the fourplex that gets built without parking is going to attract those individuals who don't own cars. And many young people are not buying cars. They don't want the cost. They don't want the headache. They're happy to get on their bike. They're happy to take public transit. So I don't think it's like a big competitive advantage. Certainly in the long run, it won't be a big competitive advantage to have a lot of parking because people are not driving cars. That seems to be the direction things are going. And back to what I said about Edmonton, that's a 15-minute city protocol that's actually being supported. Okay, this is a good one. Oh boy, guys, please take your anxiety meds. We've got no anxiety. I don't know what you're talking about. Deals are happening 2 months ago. This is obviously a realtor, and maybe he's doing well. But the point is, I don't have any anxiety around it. All I'm trying to do is share data. I'd like people to not have anxiety around it and get out of the emotion of it and just look at the data. So this happens to be a realtor that is good and optimistic. Good. That's awesome. Not many realtors are being optimistic these days. Certainly the realtors who've been in the game for a long time, they're working through, realize it's just a cycle. This cycle appears that it's going to last a while yet. So this particular realtor, markets go up and markets go down. Check the stock market, just chill. That was his comment to us. Got it. We are chill. All we're doing is trying to share with you, and especially for those of you who are investors, to be heads up. This is a market, and I want to riff off this just a little bit. This is a time where we've shared many times. If you're investing, if you own properties, here's the suggestion. First and foremost, is if you've got a good tenant, you want to hang on to them. We know that rents are in fact getting softer. So my suggestion is be very clear on your market before you try and do an increase with your tenants. Now, here's a pretty savvy move, a sophisticated move. If you've got tenants and let's say their lease is coming due in 90 days, 120 days, if they're good tenants, you may reach out to them now, early, 128 days left. Say, hey, you're such a great tenant, and I really want you to hang around. If you're willing to renew your lease early or extend your lease for 12 months, 6 months, whatever your particular methodology is, I'll keep the rent the same. Or you might add a bonus, whatever that is. The point is lock the tenants down that you've got, if they're good ones, keep them, and get that lease signed a little bit early or extend it, because things are going to get softer. And I think I can say that as a blanket statement. There's going to be some exceptions to that, but very few. So depending on what city you're in, you're pretty much going to see rents getting softer. It doesn't mean they're going to come off the cliff, but they're definitely going to get softer. So if you've got some good tenants, hang on to them. Be proactive, don't be reactive. So I just wanted to point that out, given that somebody's considering that we got to take a pill or chill or whatever they're saying. This next comment / question is actually a good one. And this particular comment was, with the pain that is still to come, yes, there's going to be pain to come in some regions, not all, and in some property types, not all. While the market is resetting, which it is in fact doing, do you think the freehold detached properties will continue to make up for the lost value of the dollar from the insane inflation we've seen and may continue to see some degree in Canada? This is the base case right here. This is the foundation for why we continue to invest in real estate, why we actually look at a softening market as the opportunity, because you get motivated vendors, you get to solve problems that benefit both sides of the equation. The point is this: there is no question fiat currency continues to decouple, devalue. And depending on how far you want to go down that rabbit hole, it can get pretty bad. I mean, to the point where they're talking about US being lost as a reserve currency, the US dollar being soft. Canadians are not, we have the same issues. So the point is this: we need to own hard assets. We need to own stores of value, and real estate is that store of value. That is that hard asset. And right now we look at it and many investors are going, the world's coming to an end in terms of real estate. Prices are going to come off. Prices are going to crash. Yeah, they've come down 23% off the highs of 2022, but I don't think it's going to be that 60, 80, 50, 40% drop that many are calling for. Yes, in that condo market, I see that happening in Toronto and Vancouver. It's already happened in parts of Alberta, Edmonton, Calgary. I mean, that condo market's been a mess for years. The point is that in the detached, which is what this comment is on, yes, own single family detached, single family being 5 units or less. If you can get the financing on it, if you've got some cash that you want to put to work, yes, that market is still a good market to put your capital to work to stay ahead of that inflation. And you can't look at it in the short term. You got to look at it in a 5, 8, 10-year window. But you will, I believe, that's what I believe is where I've got my money, is in real estate. And the long term is still very bullish in terms of staying ahead of the weakening dollar. Okay, there's a couple of comments here that I want to speak to, which, yeah, for sure. I'm a renter who won't buy till prices drop 80%. Well, I believe that you're going to be renting a very, very long time. But hey, listen, the next one is, unless you can reliably rent it with adequate cash flow to cover maintenance, taxes, fees, etc., it isn't a good investment. Well, that's just the truth. But just in front of that, you got somebody who's waiting for prices to drop 80%. They're going to be your renter. So buy for cash flow. Make sure that that cash flow, that you can maintain it. So in other words, look into the future and say, are rents going to continue to increase? As of today, no, they're not going to continue to increase. Unless you happen to buy something really under market, then you're going to see some price, you're going to be able to increase your prices. But don't count on increased rents for the next 18 months, I would say, at least. So if you're already marginal cash flow and you have to do the math of what if rents come down 2, 3, 5% over the next year or so, will you be able to hang on to that property? Does it still make sense if rents come down? And they will get softer. Okay, next on the list is, here's somebody who makes $100,000 and still doesn't qualify for a mortgage. That's just the reality of what's going on. And it's not just affordability, by the way. It is what's happening with the banks as they tighten up to mitigate their risk. They've got a lot of risk on their books. They have no choice but to slow things down a little bit. It's an interesting dilemma that the banks face because they make money by lending it. That's how their system works. So if they're not lending money, they're not making money. And on the other side of that is that as the markets tighten up, they have to mitigate their risk. So they're not being so casual, if you will, or so willing to lend money. And so $100,000, as much as that's not a great income in certain markets, 100,000 will buy you a lot in Regina, Saskatoon, even Edmonton as an example, and other markets. But the point is that the banks are also tightening up. So that's just the reality of what's going on. And that's why we go back to, you will own nothing and be happy. This keeps going back to that play. And, there's some that argue it's intentional. Who knows? the point is that's what's starting to unfold right before us. And finally, this last question, it was a comment, fascinating. Ron Butler, who is the angry mortgage guy. Ron is, he's even a little older than me. He's been in the mortgage industry for many, many years, and he's very astute in how he assesses markets. He was talking about AI. I think there's a fundamental is that everybody's anticipating jobs being replaced by AI. And while I think that's going to be true in some cases, the other side of that is I'm talking to business owners, astute business owners, and I mean CEOs of large corporations, they're actually not looking at replacing staff. This is interesting. And you start to realize that we look at the doom and gloom. So back in the 80s, I'll tell a quick story. Back in the 70s, I was working and computers were a thing, and 1 gig was a giant, took up a whole room, 1 gig of hard drive or memory. My point is this, is that back in those days, we thought computers were going to put us all out of work. What happened? It didn't put us out of work. It actually created a whole industry and then blew things up in a very positive way. We are looking at AI right now, the early adoption of AI. It's going to put people out of jobs. We're going to have people wandering out around the streets with nothing to do, all of those stories. But as I'm talking to CEOs, the shift is this, is that they're encouraging their staff to learn AI. As a matter of fact, some are not even encouraging it. They're insisting on it because what it's doing is making them far more efficient. So now when you have staff using AI, their output is increasing. They're becoming more efficient. And so they're actually not just encouraging, they're insisting that their staff get into the AI world, learn it, apply it in the jobs that they're using so they can be more efficient, more accurate, or whatever measurables that they might have. So maybe not so doom and gloom as in terms of job replacing. It is actually a new tool to improve on the jobs that people are doing now. It's just a different way to look at it. I don't think enough people are. They're only looking at the dark side of it. And I think that what I'm starting to see is where it is in fact going to be leveraged in a really powerful way so that we produce more. And production is what this country needs. So JG and I appreciate you, and we appreciate all the comments that you give us. So even the kind of trolly ones. So if you've got more ideas, more thoughts on investing, on what's happening in the real estate market, the shifts that are happening, the shifts that you may be seeing, or whatever madness you think is coming up next, hit us up below. Until then, we'll see you on the next episode. If you enjoyed this episode and you want to hear more of what JG and I have got, check out our last episode. It was epic.